attendees are in listen-only mode.
Good evening and welcome to tonight's Premium Account Short Form Market Update. The information is prepared for general information of traders and investors. The information does not take into consideration the specific needs, investment objectives or financial situation of any person. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presenter tonight, myself, Leon Hine, current Managing Director of Global Equity Management and the Investment Manager of the Investor Signals Unit Trust. The format for today's or this evening's presentation is we quick overview of the global macro outlook driving equities. We look at our preferred buy and sells, price targets and valuations on those names, asset allocations, and conclude with the short-term market outlook. The services that we provide are up on screen there. If you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Moving straight into a graph of the XJO. So again, this is a short form webinar tonight. So our focus here is just to set the scene for where we see the domestic market heading, and obviously driven from macro events there. So the US market maintains at about 14.5 times forward earnings. The S&P 500 is forecast to grow somewhere between 8 to 10% earnings. The March quarter gave us no reason to think that that's not going to occur on an annualized basis. The key notes from the March quarter earnings in the US is that revenue line growth was limited, but bottom line profit growth was quite strong. I guess the thing to take into consideration, or one of the key points to take into consideration for the June quarter numbers coming out of the US, is that we'll have an environment of a slightly higher US dollar. So there's been a fairly significant shift in the currency markets globally, and that's largely been predicated off the back of a stronger US dollar, and I'll talk in a moment about the impact that's had on the Australian equity market. From a valuation standpoint here domestically, we're trading in excess of 15 times earnings. The yields are compressing down and PEs are at historical high levels. Again, we'll look at that closer as we get into a few of the names that we cover tonight. So at 5,200 points, from a current earnings perspective and some of the headwinds that we're likely to face at a macro level over the next 3 months, I would suspect we're sitting reasonably close to full value. 5,200 I think identifies some level of resistance in our market. Our base case for some time's been that essentially from May through to September our market largely moves sideways. We think any sell-offs will be a buy on the dip opportunity, just simply supported by this macro issue of low global bond yields, which means that investors are going to come in and buy up the defensive yield names on any sell-off. So that sets the scene for a macro view in this short form webinar. Let's drill into a couple of the stocks that we're active in at the moment. So AGK we like, just to go through some specifics on this business. The company's likely to grow about 7% earnings in the 12 months ahead. That is downgraded from earlier expectations of 10% growth, but on a forward yield into 2014 of about 4.5%, and a PE of 12 times earnings, we think the stock's good value down here at around $14.50 to $15. We're owners of it, and on a rally back up to around $15.50, we're selling calls at around the $16 level. So continue to like AGK. In the Australian banking space, we've been warning over the previous weeks that prices are starting to get a little excessive, and it really, the start of that sort of strong move came off the back of ANZ's better earnings result. But I had made comment, and I suppose to add to that, not only better earnings result, but also increased dividend payout ratio. So in previous weeks, we've spent a lot of time talking about the internal earnings numbers within the banks and some of the issues. While on the surface they look good, but when you dig a little bit deeper, some of the increased earnings have come from add back of loans, or the reprovisioning of bad loans. The share prices have performed well off the back of the better payout ratios. However, the reality is loan growth's been fairly benign. However, we are starting to see the very early signs of a better pickup in, say, mortgages as an example. Hopefully we see that flow into small to medium enterprise business loans. But at 5% dividend yields, 15 times earnings, the Australian banks are expensive when you consider that they're not getting again that top line revenue growth. However, this is one of the sectors that should be well supported on a sell-off, and at around sort of 28.50, I think it's worth taking another look at ANZ as an example. That At that value, it had put the stock at about on about a 5.75% dividend yield and trading at about 12 to 13 times forward earnings. So you can see the mark on screen there for where I think ANZ starts to become interesting again, and we're willing to step back in. At a one of the big rotations in the market's obviously been where we've seen money come out of some of the banking names, out of some of the defensive yield names, and we've started to see this rotation into cyclical or growth stocks. BHP's been a beneficiary of that for some time now. You can see there where we highlighted that it was value down here at around $31, $32. We've got a target of the stock trading back up to around $37. We think that's when we take the advantage of the opportunity to sell covered calls anywhere at around that $38 level over the next few months. I think at about $37 it captures the bulk of this recovery here in BHP at the moment. From an earnings standpoint, BHP's yielding about 3.5 to 3.8% on a forward basis, and allowing for about 10% earnings growth into 2014 puts it on about 11 times forward earnings. So still relatively cheap when you compare it to, say, something like Wesfarmers that's trading at around 21 times earnings. So that's that big disparity that we're seeing between sort of the defensive names and the cyclical names, and we're starting to see that close a little bit, or at least some money come off the table and move back into these cyclical names. Moving on from BHP, from a value standpoint, Coca-Cola, the company's missed earnings guidance. They were looking for 5% earnings growth. The company's warned that they're going to deliver flat earnings. So in the result ahead, so that's where we've seen this big correction in the share price. I think you'll get some volatility around this price adjustment, but ultimately at around 12.50 to 13.50 thereabouts, the stock's going to consolidate. That puts it on a forward yield of about 5%. And a PE of around 15 times earnings, and I think the probability that it creates a new base and the stock moves a little bit higher back up towards that $14 level. So at around these levels, we're happy to redeploy capital into Coca-Cola. Moving on from Coca-Cola, Leighton. So we've seen some of these mining services companies in the last week miss on the earnings results, or advise the market that they're not going to meet earnings expectations. So we've seen downgrades across all the major mining services company. What we're seeing here with Leighton's is the opposite. The management's reaffirming that they're going to deliver full year guidance, and the company is very much focused on growing the business in Asia. I think that's a story the market's going to continue to like. We've been waiting for this sort of sell-off and a buy on the dip in Leighton's. It's been on the radar for some time, but we haven't been quite ready to allocate capital to Leighton's. I think that picture's starting to change, and quite possibly on a 3 to 5 year outlook, I think the story for Leighton's starts to look a lot better. From a valuation standpoint, the stock's trading 10 times earnings on a dividend yield of around 5.5%, and I'm getting more comfortable with some of the commentary that's coming out of the board at the moment. So I continue to be drawn towards Leighton's as an opportunity that we start to look at closer. Likewise, within the property sector, Lendlease, a little bit cautious on some of the pure property trust plays. Their yields are compressing down too far, but some of these blended businesses like like Lendlease or Stocklands, where you're getting an element of a property trust with actually a development company, or where they're a little bit more active in recycling capital and engaging in development projects. At 10 times earnings down here, Lendlease, I should say, is a buy on the dip down here at around $10. So we're attracted to Lendlease on a 4.5% dividend yield, and you can see here, I'll just shift this forward a little. So as we go through this current sell-off at the moment, anywhere down here around $10 starts to look interesting for us. Origin Energy, so part of this rotation out of sort of yield, we've seen some of the energy plays do well this week with Origin, Oil Search, Santos. However, from a valuation standpoint, they're starting to get a little stretched. So Origin, The company's already warned that they're going to deliver flat earnings in the 12 months ahead. I think that's a temporary trend in the business. I think if you go out 2, 3, 4 years, the company will re-accelerate earnings up to 10%. The Asia Pacific LNG project that they've got up in Gladstone starts to come online around 2015. I think this is a long-term buy on the dip story with Origin, but short-term we're starting to push up against full valuation. And to put some numbers around that, the stock's trading about 19 times 2013 earnings. It's on about a 3.7% dividend yield, and with flat earnings growth in the 12 months ahead, those numbers don't change too much. But so somewhere around $14, we're obviously owners of it at lower levels, and we're starting to look to take profit up here at or near these levels at the moment. A quick look at one of these names, just as I made comment at the beginning of the session about the currency market. We've seen the Aussie dollar come off from sort of 105s back down to 97. What that's meant is companies that have large US offshore earnings, so your Brambles, QBE, Amcor, Sonic Health, just to name a few, have all done well. So that theme, I think, has sort of ran its course, where we've had this initial rotation of capital into these names that can convert their US dollar earnings back to Australian dollars and get an added kick as the Aussie dollar pulls back. QBE's been a beneficiary of that, along with maybe the market having a view that US interest rates won't stay low forever. I think in reality we're not going to see the Federal Reserve change the status quo. They've already flagged that they want to see US unemployment down at 6.5% before we see any material change. So we may see commentary from the Fed sort of indicating that they are watching it closely and they do see an end to quantitative easing, but the reality is they're going to keep their bond buying program in place until US unemployment falls down to 6.5%. So I think what we're saying here with QBE is the stock was good value here. It's starting to get a little bit expensive in our book at that current level. Some of the other names that we've been active in, so Horizon is obviously a name that we like. At around $4.50, I started to warn that it's getting a little bit expensive for us. It's 22 times earnings, only about a 1.9% dividend yield. So we own it at lower levels here. We've started selling calls at both the 450 level and the 420 level, and I think that sort of caps the upside for the short term. So we like QRN, but only if we were to see a pullback again at around the $4 level do we step back in. Just to finish off on a couple of these oil and gas names, so Santos. So from a valuation standpoint, it's 22 times earnings, 2.5% dividend yield. But again, you've got Oil Search, Santos and Origin all over the next couple of years starting to see more benefit from their large capital expenditure that they've undertaken in the LNG sector. So I think our strategy here with Santos is we own it at lower levels, and we've sold the calls at $13.50 into July, and I think that'll sort of pretty much cap the upside again, given that the stock's trading 22 times earnings. So we'll be quite happy to deliver that, and that'll return us in excess of 20% per annum. These names that I've mentioned throughout tonight's recording, where I've said that they're sort of getting up towards their top end of their valuation range, they're the levels that we set calls at. They're the levels that we're delivering the stock and locking in profit. And the base case for delivering stock at those levels is that it returns at least 20% return on equity or return on investment on an annualized basis. And then finally, just to look at the last couple of names tonight, Toll Holdings. So down at these levels starts to look interesting. I think it'll be a slow consolidation before we ultimately get a move higher. But at around $5, the stock's trading at around 12 times earnings and about a 5% dividend yield. So we don't see a lot of earnings growth in Toll, but I think gradually the slower or the lower interest rate environment in Australia should at the margin start to improve sort of some of the retail sector. Some of the freight forwarding side of the toll business should start to pick up a little. So we're not seeing it as a strong growth name, but down here at around $5 on a 5% dividend yield, the stock should be reasonably well supported. Just to look at one of these defensive retail names, we're starting to see some money come out of the likes of Woolworths, and just to put some PEs around, I spoke about Wesfarmers earlier trading 21 times earnings, Woolworths at 18 times earnings. So the dividend yield on Woolworths on 2013 numbers is 3.86%. We see it value down here at around 33.50. So if we were to get a pullback down to these levels during any sell-off or choppiness in the equity market in the months ahead, we're happy to be buyers of Woolworths. Within the real estate trust sector, I've been chatting about this in particular in last week's recording. We looked at how the likes of GPT, Goodman Group are all compressing down to very low yields, in some cases less than 4%. And we started to get concerned that the property trusts are getting a little bit expensive. Out of all of them, the one we like is Westfield Retail, delivering about a 6% dividend yield, and the company still engaging in a share buyback. So this is one at around $3.20. We'd be happy to step back in and take another look at it in the weeks ahead. Thank you for listening in to tonight's short form recording, and I look forward to speaking again next week.